Welcome to this video on the £1,000,000 trap and how to pivot from business ownership to financial freedom. Today, we will walk through practical, tax-aware strategies for extracting significant retained earnings from a UK limited company while preserving reputation, reducing stress, and building a slow-fire lifestyle. We will emphasize pensions, ISAs, household allowances, and a disciplined 16-year plan, plus discuss whether to pay down a mortgage or invest. Let's begin. Here is our agenda. First, we define the dilemma of trapped corporate cash versus lifestyle goals. Next, we explore why pension contributions often beat dividends for large cash extraction. Then we design a dual-track plan that lowers business overheads while compounding retained earnings. After that, we optimize household tactics using spouse salaries, dividends, and ISAs. We will also examine whether to pay down a mortgage or invest. Then we map a 16-year pivot. Finally, we cover key risks, add necessary disclaimers, and test your knowledge with short quizzes. Many successful founders accumulate large retained earnings in their limited company, sometimes over £1.5 million. But when they want to step back, reduce stress, and maintain a positive reputation, they face the challenge of accessing that cash without excessive tax. The problem is extracting funds efficiently while preserving optionality. Our objective is to pivot towards slow-fire, where the business remains stable but less demanding, and personal finances are structured for long-term independence. This content is for education only and is not financial, tax, or legal advice. Tax allowances, pension rules, and corporate tax rates can change. Your circumstances are unique, including earnings profiles, previous pension contributions, and potential tapering. Please consult an FCA-authorized financial advisor and a qualified accountant before implementing any strategy discussed here. To transition large amounts of corporate cash efficiently, employer pension contributions are often more tax-effective than large dividend payments. The standard annual allowance is currently £60,000, subject to rules, tapering, and carry-forward availability. Employer contributions can reduce corporation tax and compound within a tax-sheltered environment. Dividends remain useful for flexibility and personal cash flow, but they become less efficient for big extractions when compared to pension contributions. Therefore, we typically blend a small salary with modest dividends to cover living expenses while concentrating large-scale capital deployment into pensions and ISAs. Comparing dividends with pensions, dividends offer flexible access but are taxed at dividend rates and have a small annual allowance, making them less efficient when extracting larger sums. Pensions, on the other hand, can deliver corporation tax relief, tax-free growth, and a tax-free lump sum subject to rules, making them particularly powerful for long-term wealth building. Consequently, for significant, repeated extractions, pensions are often the superior route. Here is the dual-track approach. First, reduce business overheads so ongoing profits are predictable and sufficient to fund basic living expenses, for instance around £55,000 per year, via a small salary and modest dividends. Second, ring-fence historical retained earnings exclusively for wealth building. This means prioritizing maximum pension contributions and ISAs rather than funding everyday consumption. Then, repeat the process every year and automate contributions to maintain discipline and consistency. Within the household, consider spouse salaries where they are commercially justified to distribute income and national insurance efficiently. Structure shareholdings to split dividends and utilize both personal and dividend allowances. Always prioritize ISA allowances across both partners, targeting £40,000 per year into ISAs to secure tax-free growth and withdrawals. Finally, coordinate pension contributions for both partners so the long-term compounding effect is shared and maximized. Here is a quick, illustrative snapshot of key UK allowances and rates. ISA allowance per adult is £20,000 per tax year, providing tax-free growth and withdrawals. The pension annual allowance is £60,000 per year, subject to tapering for high earners and potential carry-forward of unused allowances. The dividend allowance has been reduced in recent years and is currently small, so please check the latest figure. The personal allowance is £12,570, which tapers at higher income levels. Corporation tax ranges roughly from 19% to 25%, depending on profits and thresholds. All figures are subject to change, so verify before acting. This flowchart separates roles. Ongoing business profit funds essential living costs via a small salary and modest dividends. Meanwhile, retained earnings power long-term wealth engines by maximizing employer pension contributions and household ISAs. The ISA portfolio provides midterm, flexible, tax-free access. The pension pot anchors long-term retirement security. This separation prevents lifestyle creep and keeps capital focused on compounding. To decide between mortgage paydown and investing, compare your effective mortgage rate with a conservative estimate of after-tax investment returns. If your mortgage is cheaper than what you can likely achieve net of taxes and costs, investing may be superior. If the mortgage rate is higher, paying down can be prudent and provides a guaranteed risk-free return equal to the rate saved. Regardless, maintain an emergency fund, consider fixing rates to reduce uncertainty, and align the decision with your risk tolerance and time horizon. Quiz time. For extracting large amounts of company cash efficiently, which method is often most tax effective? Is it A. large dividends, B. employer pension contributions, C. a big salary or bonus, or D. a personal loan from the company? You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. employer pension contributions. They often provide corporation tax relief and enable tax-sheltered growth, which can make them especially effective for large, repeated extractions compared with dividends or salary. Second quiz. When is investing typically superior to paying down a mortgage? A. When your mortgage rate is well below your conservative after-tax return. B. When you expect high returns but have no emergency fund. C. Always. Or D. Never. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is A. If your mortgage rate is well below your conservative after-tax return, investing is typically superior, provided you keep safeguards such as an emergency fund and appropriate risk management. The 16-year pivot uses disciplined annual funding. First, channel around £40,000 per year into household ISAs to build a flexible, mid-term access pot. Second, maximize employer pension contributions each year to create a powerful long-term compounding engine. Under reasonable assumptions, and depending on markets, allowances, and carry-forward utilization, this approach can target around £1 million in ISAs and a multi-million-pound pension pot by the end of the horizon. Throughout, keep the business lean so you can live on modest profits while your capital compounds within tax wrappers. This mind map will visualize the entire plan from the central goal of financial freedom. One branch captures the business as a lean, predictable cash flow engine, providing a small salary and modest dividends. Another branch shows retained earnings allocated to employer pension contributions, including carry forward, and to household ISAs with rebalancing. A risk branch highlights emergency cash reserves, interest rate hedging, diversification, and appropriate insurance. The mortgage branch compares expected returns to borrowing costs and lays out invest versus paydown decisions with safeguards. The timeline branch maps milestones across years 0 to 3, 4 to 8, 9 to 12, and 13 to 16. Finally, the governance branch emphasizes collaborating with an accountant and an FCA-authorized advisor, conducting annual reviews, and tracking rule changes. Here is your practical action checklist. First, map your essential spending and confirm annual living costs around £55,000. Second, set a small salary and modest dividends to cover those essentials only. Third, automate employer pension contributions, aiming for the £60,000 annual allowance if rules and tapering allow. Fourth, maximize household ISAs at £20,000 each, reviewing allowance changes annually. Fifth, build an emergency fund covering 6 to 12 months of expenses. Sixth, decide on your mortgage strategy by comparing the rate with your conservative after-tax return and then choose to invest or pay down. Seventh, document an investment policy statement covering risk, asset allocation, and rebalancing. Finally, schedule an annual review with your accountant and an FCA-authorized advisor. These are the key points. For large cash extractions, pensions often outperform dividends. Live lean on business profits while channeling retained cash into tax wrappers. Use ISAs for flexible midterm access and pensions for long-term security. Your mortgage decision should hinge on the comparison of borrowing cost versus conservative after-tax returns. Lastly, a disciplined 16-year plan can build two complementary safety nets, one accessible earlier and one for later retirement. In summary, Move from the cash trap to a healthy trajectory using the dual-track plan. Keep lifestyle funding modest through business profits while deploying retained earnings into pensions and ISAs. Evaluate mortgage decisions by comparing borrowing costs with conservative after-tax returns. Finally, review your plan with professionals and adapt as tax and pension rules evolve. Thanks for watching. If you found this roadmap helpful, please like, share, and subscribe. In the comments, tell us about your own pivot plan, your challenges, and what you want us to cover next.